Imagine putting your hard-earned money into an investment, expecting it to grow, only to see it shrink before your eyes. It happens more often than you think. In fact, studies show that nearly 80% of retail investors underperform the market, not because they pick the wrong stocks, but because they make common, avoidable mistakes. If you're just starting out, don't worry, I've got you covered. Today, we're breaking down the top 10 investing mistakes beginners make, and, more importantly, how you can sidestep them to build lasting wealth. Before we dive in, remember, this video is for educational purposes only. Investing involves risk, and while I'll be sharing valuable insights, always consult a financial professional for personalized advice. Let's kick things off with the first and perhaps most dangerous mistake: investing without a plan. Picture Olivia, a 25-year-old excited to grow her wealth. She jumps into the stock market, buying whatever's trending without a clear goal. A year later, her portfolio is a mess, random stocks with no strategy. The fix? A solid investment plan. Start with your goals. Are you saving for retirement, a home, or just long-term growth? Then, decide on an asset allocation that matches your risk tolerance. Next up, chasing hype. If you remember the GameStop frenzy or the crypto booms, you know how easy it is to get caught up in market mania. But here's the reality. By the time a stock is all over the news, the real gains have often already been made. Instead of following the crowd, focus on fundamentals: revenue growth, profitability, and long-term potential. Third, ignoring diversification. Imagine Liam puts all his savings into one hot tech stock. If it soars, he wins big, but if it crashes, he's in trouble. That's why spreading your investments across different sectors and asset classes is key. Diversification reduces risk and keeps your portfolio balanced, even when one area of the market struggles. Number 4, neglecting fees. Many investors don't realize how small fees can eat away at their returns over time. A 1% management fee might not sound like much, but over 30 years, it could cost you tens of thousands in lost growth. Low-cost index funds and ETFs are great alternatives to minimize fees while still getting broad market exposure. Fifth, trying to time the market. Even professional investors struggle with this. Noah pulls his money out when the market dips, planning to buy back in when things look better. But by the time the market recovers, he's missed the rebound. The best approach? Stay invested. Historical data shows that missing just a handful of the best trading days can dramatically lower returns. Coming in at number 6, ignoring the power of compound interest. Investing early and consistently can turn even modest savings into significant wealth over time. Emma starts investing $200 a month at age 25, while James waits until he's 35. Even though James eventually invests more, Emma ends up with nearly double the wealth by retirement. The lesson? Start as soon as possible. 7th, letting emotions drive decisions. Market downturns can be nerve-wracking, but panic selling locks in losses. Instead of reacting emotionally, have a long-term strategy and stick to it. Market fluctuations are normal. Historically, they always recover. 8th, failing to rebalance. Over time, your portfolio can drift from your target allocation. For example, if your stocks perform well, they may make up a larger portion of your portfolio than you originally intended, increasing your risk exposure. Rebalancing once or twice a year ensures your investments stay aligned with your goals. Mistake number 9, neglecting tax efficiency. Not all investment accounts are created equal. If you're investing in a taxable brokerage account, things like capital gains taxes can eat into your profits. Utilizing tax-advantaged accounts like IRAs and 401ks can help you keep more of your money working for you. And finally, number 10, going it alone. Investing can be complex, and while DIY investing is great, seeking guidance from experts, mentors, or even robo-advisors can provide valuable insights. So, which of these mistakes have you seen or maybe even made yourself? Let us know in the comments. And if you found this breakdown helpful, why not hit subscribe? That way, you won't miss out on more insights to grow your wealth and secure your financial future. We think you'll like the video on screen next. It's packed with more tips to help you on your investing journey.